Morning, good afternoon, and welcome. On behalf of Silicon Valley Bank, I want to thank everyone for joining us today for the second edition of what has become the annual Future of Climate Tech report. My name is Kelly Belcher, and I'll be the voice that you hear for the next 20 or so minutes. I'm joined by a very exciting panel of individuals who are all integral to the climate tech ecosystem. Looking forward to getting to that point in the webinar so that we can chat about the report itself and also hear their perspectives on what's going on in the world of climate tech. So today we're going to talk a little bit about global warming. We're also going to focus on how climate technology is being scaled and invested in to mitigate and control some of that warming to the point where we can all live in a world where climate is not an issue. We need this technology to scale, and we're going to talk about the investment dollars flowing into the space. So a little bit about the agenda. Again, I'm going to spend a little time talking here about the report. We're going to get into the panel, and then at the end we'll save some time for Q&A. So please don't be shy. Submit your questions through the chat or the Q&A box. It'd be great to have this be as interactive as possible. Next slide. So again, my name is Kelly Belcher. I'm a managing director on SVB's Climate Technology and Sustainability team. This is a team of mission-driven individuals. We all came to SVB as a purpose-driven for personal reasons to invest our time, invest the bank's capital and energy into preserving the Earth's natural resources. We're able to do this through the bank, which is, makes every day not work. It's fun. We spend a lot of time with entrepreneurs who have very, very interesting technologies. And I'm joined today by a couple or several people who are all in the same ecosystem. Very excited to have Emily Kirsch on board. So she's the founder and CEO of Powerhouse. She's also the founder and managing partner of Powerhouse Ventures. If you don't know Powerhouse, their firm's mission is to decarbonize the planet, and they're doing this through action and investment. So happy to have her involved today. Mateo Jaramillo is also with us. So Mateo is the co-founder and CEO of Form Energy. For those not familiar with Form, battery storage technology, it's extremely disruptive in the space. They've built a super interesting piece of technology that can help extend the life of renewable energy. So when we're able to capture energy from the sun and from wind, we can store it. They extend the life of that asset and put out energy when times are grim and we don't have access to the grid. So very excited to have Mateo here. And then our esteemed moderator who will come on later, Hernbroth from Axios. She's a reporter there, spends a lot of her time on climate tech reporting. If you don't have Axios and you're not subscribing, do it. It's daily emails. They also have a really cool app where you can spend some time looking at articles that they come up with, and Megan's instrumental in putting out a lot of good stuff on the climate tech space. So happy to have her moderating today. So again, Silicon Valley Bank, this was something that I'm very proud of. We've spent a lot of time trying to figure out how we can, as an organization, contribute to the climate tech space, in another sense, to mitigate global warming. And the way we're doing that is by putting our money where our mouth is, so to speak. We've contributed up to $5 billion to be allocated over the next 5 years to the space. My guess is that's the minimum we're going to spend, and hopefully we're able to do some good things. And you'll see on the right of the slide, this is not an exclusive list. This is just a broad representation of where we want to focus that attention. And we're going to do this through our project finance, our specialty finance, our direct equity platform, our investment bank, our private bank, and also our general banking platform, where we help entrepreneurs start their businesses and grow those businesses over time. And so without further ado, let's maybe dive into the report. So the way this is going to flow, we kind of took some high levels from the data that the team put together. We're going to talk a little bit about the biggest problem, which is global warming. That's the illness, the symptoms being the emissions that we emit as human beings, and then how technology is being developed and invested in to kind of control those symptoms and hopes that we can prevent the planet from heating up too much to the point where we have catastrophic events occur in the future. But before I get into that, I do have to say a big thank you to the teams that worked on this, our market insights team, our marketing team, our production team, and all of my colleagues on the climate technology and sustainability team. Really appreciate your help in getting us to this point. So let's dive in. So if you think about where we're at as a global populace, the biggest problem obviously is GHG emissions. We measure those in billions of tons per year. To that extent, we've had 49 countries come forward and say, hey, by some point in the future, we want to be at net zero. We're going to do everything we can to invest, spend the time and control our emissions to get to this net zero target. Now, 43 of those countries have said that they're going to do that by 2050. So, we're virtually 25 plus years away. And I think that there's high probability we'll get there. The work is being done by Fortune 500 companies. The other statistic you see here, over 30% of the F500 companies across the world have committed to whether it's net zero targets or committed to putting out climate targets for their employees and themselves as an organization. And if you look under that hood, you'll notice that most of the major oil and gas companies, who, by the way, are some of the largest contributors to GHG emissions, they are also putting out their targets for to control emissions and to help preserve the climate that we're in now. So where are we at today? It's important to kind of measure. So we're going to do this probably every year, come back to this. So year over year from 21 to now, if you kind of said, okay, what if we stop doing anything and we just kind of keep the status quo? The forecast that we are looking at shows that the world heating up somewhere between 2.5 degrees Celsius and 2.9 degrees Celsius. Now you and I probably all can agree that in and of itself is a little bit scary, and I think we can do better. And so, it does give me some hope that if you take that number and you look at what the 2030 targets could be, that we're actually going to reduce that 2.5, 2.9 figure down to somewhere around 2.4. And if you add in pledges that have been done over the last 6 to 12 months, that comes down even lower to somewhere between 1.9 and 2.1. Obviously, our goal and what the major functioning bodies across the world are targeting is a maximum heating up of 1.5 degrees Celsius. And to get there, it's going to take a lot of effort. And the reason being is if we are at a certain point in emissions today, to get to that 1.5 degree maximum number, the emissions need to get much lower. So if you look in the bottom left of this chart, at current time of this report, we're emitting as a global populace somewhere around 55 billion tons of CO2 a year. The 1.5 degrees Celsius warming target needs us to get down to 25. So the delta is a $30 billion tons delta. And that's a massive number. And so what we've done at SVB and what other people are doing across the world is trying to figure out how do you quantify that in terms of spend? Like how much money can we spend to get to the point where we cover that emissions gap? And so our best guess at this point is somewhere just above $2 trillion. That's US dollars. And so if you look at how much we were thinking we needed to spend was around $3.5 trillion. In reality, where we sit today, our best guess is that number is probably closer to 6 trillion. And so who's going to fund that? Our best guess, again, is some mix of private lenders, private equity providers that can include venture capitalists. There will be some work in the capital markets, some public equity listings, some governmental development institutions. And I think all together, if you kind of break out each one of those pieces, we should all be thinking about increasing our pledge to the space by at least 20%. That's kind of the average number of increase that needs to happen to go from 3.5 trillion to this $5.6 trillion number. And so maybe we'll move to the next slide. So how do you do that? So what's the catalyst to kind of get those emission numbers down? Where are we going to spend that $2 trillion? I believe, and I think most people who have joined the call would believe, that technology is kind of the catalyst to get us there. So we can take investment dollars, we can deploy it across different types of technology in hopes that at the end of the day, the emissions come down and the temperatures across the globe don't accelerate past the point where we feel like we can sustain our lives as they sit today. So this hype curve, I like the title, Get Hype for Climate Tech. I don't know if anyone wants to jump up and fist bump, but it is an interesting space, a lot of activity. We spend a lot of time on this curve. The one we put together last year was, I think, a good starting point. And what I would say about this year's curve is that many of the technologies we had that were in the innovation trigger side have now moved along the curve into different spots to where we think that there's a high probability in a short period of time that they get to productivity. So the way to read the chart is you've got opposite poles. On the left, you've got the innovation trigger, which would include very, very early stage technologies that have the potential to have very high expectations for climate mitigation. On the far right, you have technologies that have been invested in for long periods of time. They're now in a state of productivity. They might, in certain scenarios, be commoditized, but they're definitely democratized. So the global population can all agree that these are productive technologies that support positive climate change. And then the technologies in the middle, they kind of flow across the curve from, if they're at peak expectations, which means we think high probability these will become productive, or they've come down the curve, we are becoming disillusioned and we're about to be enlightened by these technologies. And then we segregate them by time, which we think will elapse before they move to the next point in the curve. So green means shortest term, orange is sort of midterm, and then blue and gray are longer term. And so best example I can give on long term, I think most people would agree that nuclear at this point seems like very much a binary outcome. However, there is quite a bit of investment dollar flowing into space. I think that it could be a game-changing technology for energy creation and distribution. So my guess is that somewhere in past this 10-year point, this technology will move along the curve, and I sincerely hope that we get to productivity with nuclear. And so I would also call out kind of the bottom of the chart. It's a good heat map of where dollars are flowing by time period. So it's no surprise that venture capital tends to flow into technologies that have a high probability of becoming successful in a short amount of time. So if you look on the far left, you'll see things like EVs, battery storage, supply chain, solar, biotech, wind. These are technologies that we believe at SVB will become productive within the next 2 years, and it's no surprise that the most amount of VC dollars have flown into that space. As you kind of scale out over the continuum of time, you get into these kind of 2 to 5 year technologies, precision agriculture, alt proteins, which include plant-based foods and food and ag tech. A lot of VC dollars flowing into the space year over year. And I think we have this pegged just right. 2 to 5 year time frame seems appropriate for these technologies to become productive. And then further out on the continuum, you have biofuels, you have carbon capture systems, nuclear. These are all spaces where investment dollars are flowing in, projects are being put together. But it's our belief that we're still in the infancy stage here, and it's going to take more time to scale these to get to the point of productivity. Next slide, please. So where do the dollars come from and how are they being raised? If we need $2 trillion in investment over the next several years, Where is this money coming from? The good news is we've been on quite the hot streak in climate tech investing. So let's advance the slide here. So you'll note, no surprise, lots of capital being raised and orders of magnitude more capital being deployed. So from 2020 to 2021, we went from 94 fund closings to 129 fund closings. So massive uptick in the amount of funds being closed. And then an even more shocking figure, 18 billion capital raised to 26 billion capital raised from 20 to 21. So a monstrous increase in the amount of capital that US venture capital funds are going out, their LPs are supporting, dollars are flowing in for investment. So what this does is allows new funds to enter the market, existing funds to raise their next 1 to 2 funds, and then deploy that capital into the climate tech space. I think the data on the top right is super interesting, shows that we have a lot of experienced investors in climate tech. But I think the takeaway that I would make a point on with this data is many of those are very early stage. So you have the majority of investors playing in the seed and Series A stage of life, and where they like to deploy capital. And it starts to tail off as a company reaches its Series B and starts to mature into C and D, and probably at the point of transaction, there's even less seasoned investors in those spaces. So I think what that tells us is that we're still in very early innings of climate tech investing. There tends to be a preference by venture capital to get in early in the seed and A and stay with that business. But then new players come in to lead those rounds as the business matures, which is not that atypical. But it is interesting to note that the vast majority of investors are seed and Series A investors. So where does the capital go? If you look at the graph on the bottom left, you'll note that there were 1,316 deals in 2020. In 2021, we added 300 deals, so we did 1,600 deals in 2021. The amount of capital invested into climate tech almost doubled. So it went from 31 billion to 56 billion year over year, which is a massive uptick in activity. So where did that money go? So if you look at capital in, you'll note that most of it went to transportation, to energy and power, and to enabling technologies like AI and IoT. And if you kind of open the hood and look at what's underneath those categories, you'll see that ag and food had the most deals. Transportation and energy and power were second, so highest number of deals in those spaces. Enabling technologies kind of falling in there. So capital flowing in across was a little bit different than the types of deals. But I think the biggest takeaway here is just the sheer order of magnitude larger 2021 was over 2020. And then the last point I would make on this slide is going back to my earlier comment. I believe we're in early innings here, but if you look at the data from last year and compare it to the data from this year, things are moving along. So investment has moved from seed to A, from A to B, from B to C, and Series D has picked up. So we're seeing 128% growth year over year in Series D financings, which is pretty incredible considering I believe, and don't quote me, but I believe last year was a much lower growth rate, probably to the tune of half of that growth rate. So what this tells me is, yes, investors are still getting in early, and that's where the majority of investors are, but they are following into these investments as the companies scale. So when a company raises its A, there's a high probability that it will raise a B round, and those same investors will come back to the table in pro rata and invest alongside those new leads that come in the B and C. So we are still very early, but we are moving along the continuum. And I think the data next year will probably show more B, more C, and more D, if I had to guess. So next slide, please. So what does that mean for the outlook? And what do we think about where we're at What do we think about what needs to happen? And I'd love to talk through a quick case study, that being electric vehicles. So we'll run through that. Next slide. So a bright future with challenges. So the chart on the top left does a good job of kind of showing where we're at today. I'll give you a quick read of it. So around 80% of the total energy produced is done from fossil fuels at this point in time. The problem with that is that 72% of GHG emissions come from fossil fuels to make energy. What we need to have happen over time is a reduction of fossil fuels and an uptick in electrification. So we need to move away from the molecule and move into the electron. We can do this and become more efficient, which is what this chart is trying to show. So energy efficiency as you reduce fossil fuels. The hope and the challenge is, as you increase electrification, you also increase energy efficiency. So how many dollars, how many joules of energy do you spend per dollars of GDP? So we think we can, at current demand, we think we can supply the entire world's energy through electrification and renewables, doing that much more efficient. So 80% of fossil fuels contribute is backed into kind of a 50% number for electrification. So you're getting almost 50% efficiency by moving over to an electrification-based energy system. I think the biggest pushback that we get being in the climate tech space is, particularly when you're thinking about energy transition, is, well, it's great and we're doing what's great for the environment, but think about this, this massive loss in talent and employment. Our numbers and our figures and what we're spending time thinking on shows that it would be more of a transition for employment as well than it would be a reduction in jobs going forward. So I think the chart on the top right does a good job of showing, even if we were to increase electrification by 50%, it still creates a massive amount of jobs. These are skilled labor, professional jobs in manufacturing, construction, project development. So my fear is not in that we lose employment. It's mainly in we don't take enough action to get there fast enough. And so the case study, the progress we've made has been incredible, and we're doing a good job. And I think with the more recent additions to climate goals, we'll get there fast. But it doesn't come without its challenges. So electric vehicles are a good example. So if you look at the growth from 2020 to 21, we went from 3.2 million vehicles to 6.4, so a doubling of electric vehicle sales. I would also like to switch over to the chart right next to it. So what also happened in that time frame was the billable material costs went up orders of magnitude of 300%, almost 200% for semiconductors, and rare earth metals went up anywhere from 30 to 156%. So as more vehicles become electric and replace internal combustion engines, the raw materials to create those vehicles is increasing exponentially. So we have a supply chain issue now, we have a raw materials issue now. This is something that we need to spend time on. And I know everybody on the panel that we'll get to in a second probably has an opinion here. And I know at SVB, we are supporting companies that are in the semiconductor space, that are in the rare earth metal space, to try to bring these costs down. So electric vehicles are great. We're reducing emissions, but we're also potentially making the cost of these cars expensive to the consumer, which we've got to figure that piece of the equation out. Next slide. So I think this may be a good time to take a break, and I'm sure you want to hear someone else's voice besides mine. So I'm very, very excited to introduce Megan Hernbroth from Axios, who's going to guide our panel discussion. So I'm going to flip the microphone to her and let her take us away here.
Thank you so much, Kelly. Hi. Great. So I'm excited to kick this off. And I think the report kind of illuminated a few interesting things for me. And I think one of the biggest things is, this isn't the first time that there has been investor interest in climate tech. And I think we all know about kind of the early 2000s clean tech boom. It's gotten a bit of a rebrand, but otherwise a lot of it has kind of remained the same. So I would love to ask our panelists today, what makes this rally different from the last time around? Both from kind of the founder and investor side of things, but also kind of across the board. I think there's a lot of, to Kelly's last point, there are a lot of changes that have happened and there's still a lot of challenges we're facing. So I'd love to start with Mateo, if you're able to take that, and then we can kick it off.
Sure. Thanks, Megan, and thanks Silicon Valley Bank for having me join today. What's different? So I've been working on batteries now for almost 20 years. So I've seen a few waves come through. And I think Clean Tech 1.0 is more or less after the financial crisis. So sort of 2000, let's say 8, 9, 10, sort of in that range. And that's, I joined Tesla in 2009. So that's where I was at that moment. I think what's most different this time around is sort of the underlying fundamentals that affect the industry, broadly speaking. And principally what I mean by that is the cost of electricity is now, it is the lowest coming from renewable energy sources. And 10, 15 years ago, we were sort of projecting forward that may be the case, but it wasn't actually true yet. And today where we find ourselves is that is the case, right? Solar is just about everywhere it goes, the marginally lowest cost form of electricity. And that sort of enables everything else around it. So that enables policies that take that into account. That enables commercial industrial customers to drive towards that as a solution because of the low cost. That is sort of the fundamentals of this new market that we're in today on this energy transition that simply wasn't present 10 years ago, and or more. And so that first Clean Tech 1.0, there was you could see it coming together. The IPCC had already convened, and they were already talking about carbon emissions and sort of parts per million rates and being at untenable levels. But the people who were really paying attention to it couldn't point to other parts of the economy that were already sort of there that you could bet on and build things on, build real businesses on top of. So that has changed. And I would say that is what has unlocked all the ancillary sort of activity around it, right? Net zero pledges, like I said, policy changes, those kinds of things. If it weren't in the realm of being economic, it doesn't happen, right? And that's where we are.
Great, thanks. Emily, do you have anything to add to that?
Agreed with Mateo on the market fundamentals. Over the past decade, we've seen a 70 to 90% reduction in the cost of wind and solar, such that it is the cheapest form of electricity almost everywhere globally today. So I think 100% spot on there. From an investor standpoint, back in 2008, climate tech investing was all about DOE loan guarantees and RPE grants. And in 2022, you all just laid out really well through the report that climate tech is now in every layer of the capital stack. And obviously for good reason. I don't think, Kelly, you covered this, but in the report, there's data on M&A activity and how many unicorns there are in the climate tech space. And last year it was just 16. And in 2020, it was 16 and 2021. So last year it jumped to 44. And as Kelly mentioned, US venture capital investment in climate tech reached 56 billion last year. It was just 7 billion in 2008. So I think it's helpful to put today's numbers into comparison. And another interesting evolution in where we are today relative to 1.0 is in the corporate space. So Powerhouse, the company, which Powerhouse Ventures spun out of, our company has clients that are global corporations, and we help them find and partner with startups that are building climate technology that those corporates are looking for. And one of our clients is Google. And I think they give us a really good example of what's different between then and now. So in Clean Tech 1.0 in 2012, Google set a goal that they would purchase enough renewable energy to match 100% of their operations. And they achieved that in 2017. And then 2.0, and this is where I think most of the world has aligned around, as you've talked about, is around net zero. So Google committed to eliminating their entire historic carbon legacy and getting their lifetime net carbon footprint to zero, which they did in 2020. And then looking ahead, I think 3.0 is the latest and most ambitious goal that they've set, this 24/7 carbon-free energy commitment by 2030. So 1.0, I think, was all about purchasing renewable energy, and there are many companies that are just starting to do that now because not everyone's Google. 2.0 is about net zero, and that's where most of the world has aligned around. 80% of global GDP is now covered by a net zero target, which is pretty stunning. But I think looking ahead, 3.0 is not net zero, it's zero. And ultimately that's what we, I think, should all be working towards. But I think globally we've aligned, corporates and nation states have aligned around net zero, which isn't bad, but I think there's still room to grow around how we think about where we're going relative to where we've been.
Yeah, and one more thing to add from my end. In 2010, we talked a lot about climate change. Today, the right way to sort of reference that idea is climate changed with a D. We exist now in a world which has a changed climate, and we see those effects, right? What happened in Texas, last year, or pick your event, right? Wildfires in California, where I live, and so that the social license, right? That's where that comes from. To sort of go back to the commercial industrial entities who are driving a lot of this stuff now. That first wave. Part of the question was, how do you get consumers involved? How do you get the regular people off the street to actively participate? And the way that they are participating is through this, the social license that is granted to businesses to operate, who are helping to solve the problem, right? And it all it takes is the basic powers of observations to understand that we do live in a changed climate and we must do something about it. And so that is when it becomes as visceral as that, it is just a different sort of operating environment for entrepreneurs, for investors, for policymakers, for you name it, right? It's really important to just note that we live in a changed world already.
Great. And Kelly, anything you would like to add?
Yeah, I think all of that resonates and makes a ton of sense. And there was an interesting article, and I don't know who to give credit to, but they talked a lot about kind of ambition versus action. And so in the early days of Cleantech 1, there was a lot of ambition, but not as much action. Today, I think we have both, right? So we have greater ambitions and we have more action. So I think, with the investable dollars, with to Mateo's point, the climate has changed, and so we kind of know now what the problem is, and we have a good grasp on how to fix it. And I think the right technologies are being invested in and developed at this point in time, which is a little bit different than 1.0.
Great. And that's a great segue into the next question is there a lot of the Cleantech 1.0 was concentrated kind of on battery development, solar panels, a lot of the things that now the cost has come down just in incredible amounts. And it's kind of contributing to this idea that the later stage companies are kind of getting a lot of financing and being able to really break ground on projects. Now that we have those kind of innovations there. But I'm curious, what are your perspectives on kind of what those technologies are and what still needs to kind of have the extra investment, what still needs to be able to be deployed at scale that isn't quite there? Mateo, I'd love to start with you.
Well, I happen to spend most of my waking hours thinking about what we call multi-day storage. As Kelly mentioned in the beginning, Forum is developing a very low cost and therefore long duration, what we call multi-day storage, which enables those weather-driven power generation resources, wind, water, and solar, to have those gaps closed, right? The multi-day gaps that are there. They operate in cycles. Of course, the sun goes down every night. It does come back every morning. That's one cycle we need to sort of bridge. But then there's, of course, these multi-day or even seasonal ones that we have to account for too. And so that's why you need this much longer duration type of storage. So certainly I spend a lot of my time there. And the reason for it is that is if you can do that, which Forum believes that we can, to be clear, then you're going after sort of that last third of the grid, which is hardest to decarbonize, maybe 30-40%, somewhere in that range. And that represents annual gigatons of avoided emissions, right? And so that's just a really big lever that you can go after. As an entrepreneur, happily, that's also the largest market I could possibly go after, right? It's a multi-trillion-dollar CapEx market. And so, the prize is big, the market is massive, and the impact is extremely measurable and massive. However, I don't think that what we need is only people taking huge swings like that. Part of the reason why the numbers are up in terms of climate tech investments is because we now classify things into that bucket that just weren't there before, right? And that's because of the scrutiny of carbon accounting. And we do really understand with much higher fidelity today, where those emissions do come from, and we can say scope 1, 2, or 3, but it just means that we understand where it's coming from. And so investing in this in a more efficient supply chain, for example, that is a climate tech company, right? And so I think that the bucket just is bigger, the definition is much more broad, and appropriately so, I would say, because indeed, everything sort of feeds back into the climate. And so I think that there are some big bets like what Form is doing, but also we need all of the bets to happen, right? And we need more efficiency to just exist in the way that we operate, less waste, of course, and all of that leading to lower emissions. So I think it's a really big tent, right? When it comes to climate tech investing. And I think, smart investors will find opportunities that maybe, on an annual basis are not gigaton, but in the sum total, they certainly make an impact there.
Definitely. Great. And to that point of, the bigger the tent, we saw in the hype curve in the report that Kelly laid out that there are a lot of different kind of technologies, especially, that are currently, the topic du jour. I'm thinking carbon removal and carbon accounting as being two areas that we've heard a lot about in the last 2 weeks. And, I'm curious how investors are approaching this given the years long lead time. I know we've also seen this in areas like biotech, where it's a very capital intensive business to get off the ground before we reach scale. How should founders approach this, and how should investors approach this as well? Emily, I'd love to start with you there.
Yeah, I think it all depends on your thesis. To Mateo's point, some people are going to take those big swings, and the technology that has the 5 to 15-year path to commercialization, and we need that, because I think global consensus that we're not going to get to limiting global warming to 1.5 degrees Celsius above pre-industrial levels without technology that pulls carbon out of the atmosphere, and so we need those types of big bets. It's also true that we can get to 90% decarbonization of our electricity sector with existing technology. And given the climate science that we all are aware of, this is the decade to make as much progress as we can. And so at Powerhouse Ventures, our whole thesis is get proven tech that takes basically no tech risk to scale globally as quickly as possible. And so our investment thesis is aligned around 3 areas. One is finance and deployment, so how to get more financing and deployment of this proven technology. 2, asset management and optimization, so how to manage and optimize the value of these assets that exist. And then 3rd, Mateo spoke to this as well, we call it market access and participation, so how to enable as many people and entities to benefit from the benefits of this industry as possible. And so for the most part at Powerhouse Ventures, we invest, if you look at the hype cycle, along the lines of the slope of enlightenment or plateau of productivity. And it's worth noting that there's this really hot debate on social media where it's like hardware versus software and short-term versus long-term, which is really frustrating because it's obviously both. We need founders like Mateo doing Form Energy and Shannon Miller at Mainspring and Natasha Cave at 12, like everyone who's doing work from the ground up, building entirely new tech like that is absolutely necessary. And at the same time, we have to get that which people have already worked on for decades to scale. So Powerhouse Ventures, which invests at the seed stage and is software and fintech focused, is really complementary to the breakthrough energy ventures of the world or the prime coalitions that take those early hard tech bets.
Yeah, what's really different too this time through on the climate tech investing space is the full capital stack is there, ready, activated, funds are formed, that they're dispersing money. You don't have to wonder whether or not, if you get through your series A and B, if there's going to be the larger tranches of capital there down the end. The numbers of entities who can do that, of course, they're smaller, but the total dollars of capital available are there. And when you have somebody like BlackRock, talking about their net zero pledges at the other end of it, you know that capital has been formed. And so there's every sort of inducement to people to come into the space because you don't have to wonder. And even 5 years ago when Form was sort of getting put together as a company, we really didn't know what the later stage capital would look like. We had the Breakthrough and Prelude and the engine, and that was it. There wasn't like a clear path for who is going to be waiting there to write a big check on a hard tech investment like what we have. And that's just, it's very different today.
Mhm. And corporates are playing a really interesting role that they weren't playing even a few years ago as market makers. I think it was just 2 weeks ago that Meta and Alphabet and Shopify and Stripe announced this close to $1 billion 8-year fund called the Frontier Fund to pull carbon out of the atmosphere. And they said, we will purchase permanent carbon removal from suppliers that are building promising new solutions that have 1,000-year storage and cost less than $100 a ton. And their motto is build and we will buy. And so going back to what's the difference between 1.0 and 2.0, 1.0 was the role of government. Government was the one, subsidizing and enabling and creating new markets to develop in a way that they wouldn't have otherwise. And now you have these tech behemoths that are providing this really important market signaling and have the purchasing power to accelerate technology development and ultimately tech adoption that wouldn't happen. So it's an interesting, as it relates to the hype curve, does that move something further along relative to what it would, how quickly it would move without them? It's a new, very new and interesting element that is accelerating these types of solutions that otherwise have a really long path to commercialize.
Yeah, voluntary markets are fascinating.
Totally.
I
Yeah. Especially from an investor
standpoint.
standpoint, it's like, yeah, absolutely. And the timeline for voluntary to become a regulated market, it's a wild space.
Anything to add in there, Kelly?
Yeah, I think Mateo made an interesting point. When you have BlackRock, Fidelity, Vanguard, State Street, those entities control something crazy like 90% of the world's wealth. And so you've really got the backing of a big balance sheet on each one of those funds. And that's a lot of institutional private capital being deployed into climate tech, especially if they're coming in the later stages. And so I think that right there signals that, and that's patient capital too. So it doesn't need a return in 12 months. It can be patient. And so I think that's a good signal for the space. I enjoy seeing those names pop up, and I'm glad that they're a player kind of in those later rounds. But I do think I'm even more thankful, I think, for the people that take the risk on the seed stage and the Series A, just because that's where the true venture risk exists. And so they're the believers, and then the institutions kind of come in and shepherd it into something extremely meaningful.
Great. And so on kind of the later stage front, in terms of exits and M&As, it's not something we addressed at the top of the call in the report, but it is something that is laid out in there. And so I'd love to kind of walk through a little bit. What does an exit or M&A look like for an investment from Emily, and then kind of from the entrepreneur side of things from Mateo?
Right. So at Powerhouse Ventures, we expect most of the exits to be acquisitions and versus going public. And we have this unique perspective given that our investors in our second fund, which we just closed a month ago, the corporate LPs, each one of them represents one of the largest companies in the world across energy, automotive, utility, financial services, and technology, which is all the areas we invest in. And so we're learning from them about what they're acquiring, what they want to acquire. And we have this unique perspective from Powerhouse, the company that has corporates as clients like Google and NextEra and Enel. And so taking all of that information helps inform the types of companies we want to invest in, the sectors we invest in, our expectations for an exit. Powerhouse, the company, has built this database of thousands of startups, kind of like Crunchbase or PitchBook, but specific to climate tech. And we add a couple hundred every quarter, and we track M&A activity across those startups. And so what we've found is that M&A activity is certainly increasing, but what's interesting is the stage of company that's getting acquired is getting earlier and earlier, which bodes really well for us because we're seed investors, and because we invest in software-focused companies, there is a fast path to commercialization. We don't anticipate it to take 10 years for an exit. But to give an example from our portfolio, in our first fund, we thought that as generalist AI platforms were expanding into the tech market broadly, we saw an opportunity for a startup using AI for renewable O&M to find an early path to an acquisition. And so we invested in a a company called Ensemble Energy that builds predictive analytics for clean energy O&M using AI and physics-bound models. And they were acquired by a company called Spark Cognition, which is a global leader in AI pre-IPO. And they acquired Ensemble in part because despite the fact that they were just a seed stage company, their customers included E.ON and AEP and EDF, and they had over 3.5 gigawatts of assets under management at the time. And so those are the types of exits that we anticipate, for new technology leaders that are generalists but are looking to make a move into the clean energy space. Spark Cognition already had an energy practice. It was just a fossil fuel based one. And rather than building this capacity in-house, they decided to acquire Ensemble. But then of course, there's also opportunities for an exit with the oil and gas industry, with tech giants, with insurance, with fintech, utilities. And then of course, we're holding out for a couple IPOs. So yeah, that's how we see the opportunity for exits in our space.
Yeah, I certainly just sort of observe a lot of M&A activity that is happening in the space, and smaller companies getting bought. We've bought, in fact, a couple of sort of defunct battery companies. I don't think everybody would call those exits for those companies, but we acquire the assets and move them on. For a company like Form, obviously we're very hardware focused. We do have a lot of software development, but primarily the product is hardware. And so for us, the other really important tranche of capital is project capital. And we didn't talk about it in the report, but that is extremely important for us. And thinking about where that low cost capital is going to come to build those projects that makes Form a valuable company. We need to go do that ourselves and sort of catalyze that piece of it. And that part has also shown up, and we find very willing capital partners in the project deployment space as well. And for us, the longer term, still to be determined, because we're really building the company and getting it out there. We're now of a size, we're 250 people. We'll probably double by the end of the year. We're now getting to a size where we're sort of not an easy, acquisition for a company. And so it's the total number of possible, counterparties there is relatively small, I would say. But is that possible? Sure. I guess it's possible. Especially as we prove that we are deploying these things out. On the other hand, there's lots of pathways that we could still pursue, right? Which would be lucrative for our investors, for our employees, and that includes staying a standalone company, by the way. We don't, the way that the capital markets in general have evolved, there's lots of ways to sort of provide liquidity to people who need it without sort of, becoming public per se or going through an acquisition. So I think that there's so many more levers today than there were even just a few more years ago. For doing what you need to do with your equity. So I'm pretty sanguine about just the number of paths that we have available to us to make sure that Form is a successful company amongst all, across all the major metrics for our investors, for our employees, for our partners, you name it.
Mateo, I don't know if you want to work for Elon again, but he's buying Twitter for 43 billion. So whatever your valuation is, you can probably afford it.
I think I'm good.
And not to the Elon point, but to the point prior to that about kind of the range of options that companies have right now in terms of liquidity. I think over the last couple of years, there have been a lot of discussion around SPACs in terms of one way to go public through the reverse merger. And I'm curious, we have seen a decent amount of SPAC activity among climate tech companies over the last 18 months or so. A little less so now, kind of with the volatile public markets. But I think leading up to that, it was definitely a conversation that was going on. And I'd love to know, maybe we can start with Kelly, why is this a space where that is kind of a more prominent path to going public?
Yeah, it's a good question. My general sense is that companies that don't have traditional financial metrics, that investors look for are hard to value. So, going into an IPO setting can be a challenge to price, can be a challenge to find those fundamental metrics to create a valuation. And I think the SPAC sort of absorbs some of that friction by raising capital, taking a company through, merging it, and then putting it into the public market. So you remove some of that public friction that can come on the front end. And so that's my general take. I think, it's been a challenging place to do business for these companies, but I think that's also a factor of, just low repetitions in the space. So as more of these companies come into the public markets, and we can see value in a company that doesn't spit off a lot of cash flow, I think then, that makes it more palatable for, an investor in the public market, kind of someone who wants to day trade their 401k or their Fidelity accounts, that can potentially be something solvable for them. So, I think it does have its place. I would go back to my comments earlier. We're just so early in understanding how these companies need to transact. I think Emily's point about the acquisitions makes a lot of sense. Whether you're combining companies, you're doing M&A there. That's probably the best public markets. I think technology companies will be more fairly valued once they go public.
Emily, anything to add there?
That was a much more nuanced answer than I would have given. So the only thing to add is I think it just came down to a supply and demand issue. There was so much demand from investors for these types of companies, and there was very little supply. And, kind of economics 101, founders and startups were incentivized to take money.
Awesome. Great. Well, I want to make sure we do have some questions here from the audience for Q&A. So I'd love to kind of hop on over to address some of these as well. So first up, we have, how do we reconcile the environmental degradation resulting from rare earth mining with the increasing necessity for the materials? Is it a wiser tack to produce rare earths domestically or purchase them from overseas in terms of overall environmental impact? I'll open that up to the group.
I defer to you, Mateo. You've been working in batteries longer than any of us.
Sure. I mean, maybe it's worth it to be precise about what we mean by rare earths. And there's, there is a very specific category of materials that are referred to by rare earths, and those are usually made. They're usually involved in the making of permanent magnet motors. That's what it's primarily used for. So the question is, can you substitute those rare earths with something else? The answer is yes, you can. There are other types of electric motors that you can make. There are trade-offs involved in doing that. Where do the rare earths come from? Primarily right now, they come from China. And there is another material which is not technically a rare earth, but I think is also typically invoked, which is cobalt. And that goes into one of the versions of lithium-ion batteries as well. And that primarily comes from the Congo, which is obviously a very conflicted area. And so are there alternative resources and or that can sort of substitute, and or just generally what are other technologies that could substitute? In the case of cobalt, the entire industry is trying to figure out how to get cobalt out of its batteries because of the dynamics I mentioned. And on the rare earth side of things, finding alternative supplies to just mine. There's a lot of activity that's also focused on how do we mine things today. That mining really has not undergone any major invention for a pretty long time. And so bringing new techniques, new tools, new mindsets to doing that is also sort of part of the calculation. In the end, of course, it is still an extractive industry. And the question is, how much new material do you need to extract to meet demand versus what can you pull out of existing feedstocks through end-of-life materials, for example, through recycling, essentially. I saw battery recycling in particular is on that hype curve, but you could say even more broadly recycling, right? Because we're not talking about aluminum cans, we're talking about much higher value things that can and should be recycled. So that's sort of a walk through the woods answer. There's not a lot of specificity there, but there is a lot of attention in the space in general to certainly how we do continue with extractive industries in the best possible way. There are better ways. How do you avoid as much of that as you possibly can? And how do you still meet the demand, which is enabling a shift from one extractive industry, oil and gas, to another that maybe has lower impacts to the world overall. We have to be able to think about those kinds of trade-offs, right? We do not live in a trade-off-free world. And so we have to be able to sort of be explicit about those and then make the best decisions that we possibly can.
Great.
Yeah, well said. Nothing to add.
Awesome. Then we'll move along here. Would you say that investment dollars are aligning to the highest potential climate solutions? Are there high potential solutions for emissions abatement that are being left behind because financial returns aren't attractive enough? I'll open that up.
And a bunch of the tech.
Yeah,
Go ahead.
I don't think so. I think if you're going after big markets, the money is there. That's my experience.
Agreed. I think the one nuance that is a pet peeve of mine is a lot of funds align, their thesis is aligned around emission reductions, which I do not blame them. The thing that is missed in that is adaptation. So as Mateo said, wildfires and everything that we're all experiencing now viscerally firsthand, in California, across the country, around the world, increasingly, the need for adaptation in addition to mitigation, so addressing the impacts that we're already experiencing, is often overlooked and yet absolutely necessary. And so if you are evaluating a company that's focused on adaptation and addressing the impacts of the climate crisis, there's no GHG emission reduction potential there, but that doesn't mean that it's not a worthwhile and absolutely necessary investment because of the human toll and impact that the crisis is already taking.
Yeah, and typically, it's not like there aren't inefficiencies. So, for example, upstream methane emissions reduction is sort of a notable one where there's no real market for it. There is tech, of course, that could solve that problem. In fact, just better practices would solve the problem. You seal the well the way it's supposed to, and then you sort of prevent the emissions. And so that's clearly a gap there, and it sort of highlights a couple of things for me. One is, are the investors not going after it? But also, the smart investors for this space also know that they have to be participating in the policy arena as well, and sort of driving to the solutions, the right solutions, by the way, through good policy, which allows you to bring the right kinds of companies to bear against those solutions too. This is sort of a bailiwick of mine. Every climate tech company needs to be involved in policy in some way. I don't care how early you are. You've just done a seed fund, you need to be involved in the right way, right? There's different ways, but in the right way for your company, mapped into the policy conversation that's happening, because it is so relevant. And you're starting to see some investors, in fact, specifically stand up an arm within their firm that is focused on policy, effecting the right policy changes for their portfolio. So I think, some of these, there is certainly an inefficiency that's there. On the other hand, I think we understand pretty well, certainly much better than we used to, how to go close those gaps and to create valuable companies as a result, for sure.
Kelly, anything to add there?
Yeah, I think there's a good, the good example is, carbon capture sequestration projects. There's more of these popping up. Do they generate, massive financial return? Probably not, but are they shareholder driven? Absolutely. So I think, if you're an upstream oil and gas producer and you're not sequestering, if it's carbon dioxide or other types of forms of methane gas, you should probably start doing that. And your shareholders are going to request that you do that. And so I think it becomes not a revenue generator, but a cost that goes into your cost structure to own that asset going forward. And that's probably the way it needs to be. Now, there are certain circumstances where you can sequester CO2 and you can pump it into the ground and it becomes an ag tech kind of feature that works, but there's no infrastructure for that. So the problem there is, like, how do we build the highway to get it from the wellhead to the farm? And so that's a struggle too. So again, it's early, but I do think those become a cost more so than a financial return generator, is my opinion, at least.
Great. Awesome. Well, I know we're right up at time, but maybe we can squeeze in one more question if we do kind of a lightning round response here. We ask, what are the great debates in and around climate tech? Everyone seems to agree on everything. Where are some points of debate?
I question how much you're on Twitter. I mean, I think, yeah, well, the hardware versus software is one that drives me crazy. I'll stick with that one if we're keeping it short.
Direct air capture. I think there's massive debate about direct air capture, what actually should be done there.
Yeah, And my pet peeve is I wish we had more action and less talk around hydrogen. So that's kind of my thing. So I think it's massively important, and it seems like a lot of noise, and there are some companies that are doing great things, but it's way too much noise for me on all the media outlets for around hydrogen. So
I'll plus one to that too, Kelly.
Great. Well, thank you all so much for joining the panel. This was a great discussion, and thank you to everyone tuning in and for supplying the questions. This was a great discussion. Thank you so much. And thank you also to Silicon Valley Bank for having us all here to learn a little bit more.
Yeah.
Thanks,
everyone.
Megan. Thanks for the great facilitation.
Thanks,
Yeah.
everybody.
Thank
Bye
you.
all.
Bye.